Here, I was just checking oil prices, and pretty interesting how it's going. Nearly $80 right now. Gold still rising. You know, they pull back here, but coming back now.
Yeah, okay. So, Uncle, what do you take, Uncle? So you think it can come back down, or?
I think it will continue to go higher, to be honest, because, you know, when we look to this sort of a pullback here, of course it came back to retest those highs, you know, nearly retested, but it doesn't have to be perfect, let's say like that. But, you know, most probably, it's hard to say like the next target, let's say, about that, because there's nothing through here. It's never been in there, you know, so pretty hard to say where it's gonna go. But in terms of the direction, yeah, you know, maybe we can have, in my opinion, we can have another rally up. And if we break this top, I don't know where we could go. It's pretty nowhere to go. But like if we get the Fibonacci extension, let's say, you know, from here, well, not too sure about that, but let's say, yeah, I would have to get from here to somewhere here. The next target would be at 2,250. But if we go lower, yeah, yeah, maybe, you know, let's say, let's count as it is. But of course, we're taking the whole leg that I don't, you know, I think it's like massive leg. If we take a little bit lower, like from here to here to here, the next target would be at 2,220. So I think it's more reliable. That's a 4-hour time frame. When we drop to 1 hour, you know, because if we hey guys, I'm new to fundamental analysis. I've been looking into quant analysis. Has anyone used this website as part of your analysis? It seems like it would be really useful. Market bulls. Market bulls trade like the banks. Strategies. Tools. Cot report. Got it. Yeah, I have a video on sorry, Lachlan, I have a video where I've explained it a little bit about COT. I don't know if you saw it. But if we search CY securities, COT, you most probably can have it somewhere. This one. So you have how to trade the commitments of traders report here. You can have a look on this one. CHF is still valid for a short position. In my opinion, yeah, we're still valid because it's going to be tomorrow, the Bank of Japan. Let me send this out to you, mate. You can build your own COT, so you don't rely on someone else COT. All right, so that's I've done it, so you know, I have it here. I can show you pretty quick. COT. Let me share my screen. This one. So, you know, we have all of these we have all the info, so you collect everything. So let's say you come here, you can change for euro, you can change for gold, you can add how many currencies you would like to. So if you have the basics of Excel, that's a very easy video for you. If you don't know much about Excel, maybe a little bit complicated, but as it is step by step, it's going to be pretty easy for you to understand, because it literally goes, it's why it's not sharing my screen. I want to share oh, there you go, here, whole screen. So it's a step by step, so here, and then you take $2 things and so on, so on. So have a look. The link is on the chat. Hopefully it can help you with that. All right. Now, I have not seen this website before, but it looks pretty solid. So, there's all the websites as well, but I like to take from the actual BLS. All right. BLS, let me come back here. Euro. It's not BLS. Where did I took the data from? Borrelab statistics. No. Caught. I forgot BLS. It's not. I forgot. Where did I took the data from that day? Can't remember. Oh, CFTC. CFTC Commission. Whoops. CFTC. You can come to the CFTC website and you have the code from the actual source. Anyways, today's not about that, but hopefully you can come here to the video and have a look to it. All right. Yeah, I need to do part 2 of this video. Okay. Been a very, very long time, Luca. Hope you're doing well. What's today's video about? You mean webinar, right? I've released a video as well about talking about the PPI. But yeah, long time, man. How have you been? Good? Hi, Luca. Let me just take this off here. Hi, Luca. I'm just asking about CHF JPY. Look, if we get the link here, let me grab it for you. CHF JPY. There we go. This one. See? So, when we see these, when it comes to been a very, very long time. Your webinar, I've just got 3 payouts, so basically I'm perfect. CHF JPY will be down. Swiss National Bank would 90% cut next week. We may see Bodge a bit more hawkish. Yeah, that's exactly what I've said here. So I short CHF JPY based on my strong confidence that the JPY will strengthen further ahead of Bank of Japan's upcoming meeting on 19th of March. Here are some key points to consider. The board is likely to tighten the monetary policy this month, according to the press reports, instead of waiting until April. Initial estimates of wage negotiation results for large companies are scheduled to be released in 15th of March, so basically tomorrow. If the results indicate strong evidence of wage growth of the year ahead, we anticipate the board to start hiking rates this month. Press reports suggest that ECB is considering formally ending yield curve control and adopting a new quantitative easing policy framework involving committing to Japanese government bond purchases totaling around Japanese yen's trillion. For the yen to strengthen after the policy announcement, the board needs to convey that it's not just a one-off rate hike. The elevated level of shorts reaching the highest level since 2018 increases the risk of a squeeze that could reinforce upward momentum for JPY. On the other hand, there is a risk that SNB may raise rates later this month, creating a market policy divergence in the near term and potentially weakening the CHF further. So that's what I think. Just here, this last line here, I'm not saying that they will raise rates. I'm saying that there may be a possibility of raise, but I'm more towards the cut because the risks are tilted to the upside, but I don't think they would raise rates. Okay, just clarifying here if it's not too clear. I think I didn't express myself too well here, but that's what I mean. Looking at the S&B, most probably we will have a cut, but we can't rule out that's what they say. We can't rule out the possibility of a rate increase, if inflation comes high again, blah blah blah. I don't think so. 1.5 to last reading CPI we're down 1 to, yes, correct. So that's exactly what I've mean about it. That's good. You got 3 payouts. You mean from prop firms and those things, or like from us? Okay, let's have a look on Eurodollar here. Okay. I have something very nice to talk to you guys today. Yeah, prop firms. I'm still gathering money to fund my own account. That's good. Don't do. Okay, so let's just a quick chat on what it's on the chat here. Using prop firms to leverage your own capital to trade, it is a very nice way to allocate funds if you know how to trade, if you can manage your risk, if you can perform well. There is a, how can I say, there is a potential in there to use those payouts to actually build your own account. But remember that there is a lot of restrictions as well. In a sense, there is restrictions, but it's not restrictions. It's basically capital preservation for them. And you're most likely going to be trading into a demo account when you go to the real account. When you get payouts, it's going to most probably be a demo account. So if you can manage your risk, don't go over 5% of drawdown on the day. And I don't know what's the maximum. It changes so much. There's a long time I don't look at prop firms actually. So, but I think it's to 5% and then 10% to some around that. But anyway, so managing risk, taking good positions, it's definitely the way to manage prop firms. But good risk management. Now, if one firm goes away, I just look for another one. It's 5 and 10 years. 5 and 10 years. Targets are 8 and 5. Yeah, I go for max position week. See, everyone has your own strategy. If it works, that's good. Fantastic. All right. But don't forget that, doing some extra hours on the weekend or getting some other job, doing some freelance. There's lots of platforms online those days that you can register yourself if you're a good designer, if you're good, if you like to draw, if you like to, I don't know, there's so much infinity ways to make money, besides, only trading, to build capital to actually, put into your account. That you may be like shocked. Wow, that's a lot of ways. So remember that. And okay, so enough talk. Let's do what we are here to do today. So I don't know if you guys remember, but last week we had a webinar where I've talked about how to backtest a fundamental strategy. So if we look at here, it's on this video. backtesting fundamental trading strategies, where I go over the economic calendar, come back and, test it and see what made what move. So today I just want to get over from beginning of the year until the end, until where we are right now, so year to date. Let me close this, of what just basically happened in the last couple months. Okay, so first of all, when we had the euro dollar opening the year, we had US manufacturing PMIs higher. Okay, so what does that mean? Well, that means that US dollar got stronger, all right, because manufacturing higher, it is good for the US dollar. It's good for US economy as well. And then we had euro lower inflation, so that's not good for euro. Okay, higher NFP by 46,000, but lower services PMI. All right. So what we having on this situation? Where's my pen? This one. So what were we having on this situation here? Well, we were basically consolidated into the chart. As you can see, the candles are going from support resistance, resistance support, and like a ping pong ball, until we had higher inflation rate for US, okay, higher NFP, lower euro inflation, and higher manufacturing PMIs for US. So remember what I've always mentioned about when we have those sort of ranging markets, something is cooking. You know what I'm saying? Something is cooking. Something's going to happen. It's either way gonna go up or it's gonna go down. It's binary. It's like 1 or 0. So in this situation here was kind of pretty simple to understand that we had much more much more good data from US. So that's a good data from US. That's a good data from US. That's a good data from US as well. Now we had these bad data for Europe and these bad data for US. So one bad data and without no data coming from US, from Europe, but we had 1, 2, 3, and then after bit more, even one more good data to US, fulfilling this trend. Okay, so remember I've mentioned that quite a few times already, where I say you get 3 opportunities to enter on those consolidation areas. You got the first opportunity that it's on the top. You got the second opportunity that it's randomly placed. I'm placing randomly those numbers. It don't need to be on exactly in the middle of whatever, because you don't even know what's the middle of the thing. All right, if you think that, okay, this is the bottom, this is the top, this is the bottom again, this is the top, well, most likely this is going to be the middle. All right, continuation for the middle area, 50% of it. You don't need to be fancy about like getting Fibonacci, and let me take this off. You need to be fancy about getting Fibonacci from the low to the top and see where is exactly 50%. You don't need that. All right, it's just an estimative of where is these sort of 50%. And then with that, let me just put number 1 here, number 2, and then number 3. Number 3 would be on the retest. All right, number 3 would be on the retest. All right, number 3 would be on the retest. So 1, 2, and 3, pretty easy, pretty simple to understand. All right. So as we just saw, like market was was tending to go further to the US side. But remember, we didn't have the Europe and we didn't have ECB, even though FOMC until February, right? We only had some data coming from. Am I wrong? Let me have a look. I don't think I'm wrong. Sorry. Federal. Oh, we actually did have, well, but that was like 31st of January. So basically 1st of February, all right? So we did had like, but anyways, it was very, very on the end of it. So the whole market until here was basically getting data approach it, because they didn't had what's going to be happening this year until from the ECB and from the Fed. As here, market did rally up. Why market rally up here? Because the Fed was a little bit more dovish. Therefore, here the market was taking, all right, new year, new me, let's say, and it was taking more data dependent approach. Okay. And then, okay, so everyone seems pretty clear from this side, right? This side, everything, it's pretty clear on here. Now let's have a look on this side. After that, we did had a better than expected. Well, everyone knows that CPI, well, higher CPI is better for the currency, all right? Currency goes up. If we have a bad CPI, then the currency, the trend is to the currency go down. Why is that? I've explained it to multiple times. When we got FDIs, for direct investors looking to a country to invest the money in, they look to high-paying yields. Well, where would that be? Where the inflation is higher. Why? Because the central bank needs to hike inflation, needs to hike interest rates to keep the inflation, to keep people, off spending. So let me just drink a bit of water here. So perhaps we did had a higher retail sales for US, and retail sales show us that people have money and they are spending. Therefore, it's good for the currency, and it shows as well that inflation may come higher. Okay, why is that? Does anyone know why retail sales has a correlation with CPI? Nathan just say price. Nathan wants to be on my webinar. You happen to listen. Well, you're forced to. As long as people are buying, prices will be higher. Correct. That's exactly same. That's exactly the answer. So people, nothing. So when people have higher prices, they keep spending. It shows to us that retail sales have been booming. Whatever. Meyer, Davy Jones, all of those retail business, right? When the central bank raises interest rates, what are they trying to do is stop population to spend, and they proclaim themselves that they are helping us to save money in a sense to, now the savings account are paying more. Well, that's BS. Why is that? Because inflation is up. Therefore, in the end of the year, when we do the average dollar in cost, it's gonna be negative or it's gonna be break even, but we won't get paid anything. Okay. Why? Because of inflation. So when we talk about interest rates, inflation discounted, it's most probably negative to zero. So on that way, they have to Nathan's just looking to me. They have to Okay, yeah. Question, yeah. No, you have to speak louder. They are on. They are okay. How much this? Okay. Yep, yep. So the Nathan question was how much someone asked if it's the Boatman. Do you want to come here and say hi? Yes, that's him. Yes, that's him. So Nathan asked, what's the pricing of the houses influence on the CPI, on the inflation, basically. I will get to this question just in a minute. I'm just going to finish my rationale here first. So when we have, people keep spending and not saving the money, inflation continues to go up because it's the opposite what the central bank wants people to do. So when we take these for, oh, they say that you are good. They say that you're great. They say he that there's a lot of futures in it. Anyways, so it just CPI will go higher. So when we have a higher retail sales, there is an indicative of we may have a higher CPI as well. So this is why the market reacts on a positive way for the currency. Did you guys understand? Send me yes or no here, and I can explain again. All good? Yes, cool. Okay, cool. Now, answering Nathan's question, how does inflation impact house prices? Or how does house prices impact on inflation? Well, we have the wealth effect, we have rental costs, and we have consumer confidence as well. Because let's say like that, right? We have someone buying a property and they want to do it as an investment property. Therefore, and if you are smart, you're taking money from the bank because you most probably have an asset, an equity side of your, let's say you're 40 years old, you have 3 properties already, you go to the bank in Australia can loan out at a maximum of 80% of your asset value. So therefore, if you have $3 million in assets, well, voila, they can lease it out for you 80% of those 3 millions, and you can buy another property and you can put to rent. Therefore, this will have an impact on the rental prices. Okay, why? Because if inflation continues to go higher, the central bank will hike interest rates. And if they hike interest rates, your mortgage become more expensive. And if it becomes more expensive, someone's going to pay for that. Who's going to pay for that? The person that is paying the rent. Therefore, the rent will go up once we have higher interest rates. Now, there's another nice thing that is the consumer confidence. Where's my camera? My camera is here. So the consumer confidence tells us that higher housing prices can affect consumer confidence when people see the value of their homes increasing. That may feel more confident about the financial situation and spend more, contributing to the inflation. The exactly same thing as what I've just said about sales, retail sales. So that's how house prices impact on inflation, and inflation impacts on house prices. Now, moving ahead. So, like we had 1, 2, 3, 4 good news, 1 bad news for US and Europe. Therefore, we had these decline. Okay. And then something happens here. Higher US personal spending. Ooh, no. Really? Why? Well, because we had a 2% higher retail sales. Okay. I believe right now housing market doesn't have much of an impact on global market inflation. Clear normal daily spending is what is killing it. Correct. Yet it will give you an example. I've read that in Morocco, they had some sort of inflation and that price were going higher. Yet there was a shipping problem, actually an export problem. So products weren't being exported, and so inflation was down. And here we conclude that it's not actually pure retail sales, but other things. Oh yes, that's very interesting as well. I like that. I didn't know that. Where did you got that from? Just continue here. So higher US personal spending, again, because we had higher retail sales, therefore spending were up. Better than expected Euro GDP. Well, amid of those, wave of good news from US, I don't think a good GDP would change. And there's something here I want to explain, but it's very hard for me to explain. It's not something systematic. It's about a feeling. I don't like to say that, but that's the truth. It's about a feeling. Sometimes the market is looking for something. Sometimes the market is looking for another thing. So let me give you an option right now. You remember we just had higher US CPI? The market didn't even react to this. Why? Because the market right now is looking to unemployment data and as well not much NFP. Right? So the market it's looking for unemployment rate because the Fed will only cut if the unemployment rate and the NFP have to maintain stability. And remember, guys, unemployment rate we reach the peak this year. Okay, it will reach the peak and we stay there for a while, coming back in 2025. So that's not good, right? That's not good. When we were on this scenario of market, as we can see right now, the market wasn't paying attention to the Fed from December. It was paying attention from the data that we just got. All right, high inflation rate on US, good services, high NFP, and so on. So there is cycles on the market. You have a cycle where the market's going to be looking for something and it's going to be looking for another thing. But for now, I'm going to get there in a second. We did had a higher NFP. We did had a higher US CPI, but the market didn't react positively for the US dollar. Why? I've explained this on my daily videos on YouTube already. Unemployment's too high. Average hourly is too down. All right. So in a sense, it's not good. It's not good. All right. It's not because one thing is going out, that's everything's going to go up. No, it's not like that. With time, you're going to get that. All right. Sort of a feeling. I can't sort of explain systematically as I'm doing right now with these. ECB rate decision pauses the rate, of course, and then a press conference, higher US GDP. So, Fed rate decision as expected, euro inflation, US lower unemployment rate and higher NFP, continuation of lower unemployment. That was really good. Higher US manufacturing by 2.1 base points. So that's really good. That's really, really good. Okay. And therefore we have all of these move. Okay. But see how you have sort of a time to react? See, you have a time to react. You have a time to, your entry doesn't need to be here. It can be here. It can be here. All right. Why? Because you still have all of these move here. Well, if you get there, that's perfectly. But remember, there's another box here. And there's another one here. The market sort of gives you time. You know what I'm saying? Mate, I'm going to go in that direction. I'm going to go there. All right, but I'm gonna stay here for a second. But I'm gonna go there. All right, if you want to come later on. All right, I'm going. I'm gonna go now, and then it goes. So it's not. It doesn't need to be crazy, and it's for it. This is 1 hour time frame. You like we can go up. We can go up for 4 hours as well. Don't be, like I need to scalp the market. You can definitely, but remember, Forex is a central bank, is a macroeconomic, is a, fundamental sort of core, and it needs to be long term. You can't be rich tomorrow. You can't. You can't go and buy a Rolex tomorrow. All right. So it's just my personal opinion. You can follow your own mindset. And that's another thing about mindset. All right. I have some harsh comments on mindset, but we can leave this for another webinar. I tell the truth, guys. I don't lay around. So, I'm here to teach you guys how to actually be good professionals on trading. I'm not here to, bet everyone. No. If you don't want to, that's it. All right. Next. We finish January, we go to will be a knockoff Rolex tomorrow. So we finished January, go to February now. As we can see, February wasn't that busy. Okay. February wasn't that busy. February only had like 6 data. Why we had like what, 12? 4, 8, 9. Yeah, we had 9, and here we had 6, so 3 more. Ouch. Okay, so as we start February, let me try to put this here. As we start February, we did have the Fed. All right, so the Fed rate decision was basically as expected. We had a pause, but here was different. It was different. Why it was different? Does anyone remember that? If you remember that, write it down now. Let me drink some water as well. Okay, so basically, it was very cool. The market took a bit to react, actually. But the big thing was when we had the Fed rate decision, after that, we have all the monetary policy statement, and we have this speech by the chairman from the central bank, that basically Jerome Powell from FOMC, Federal Open Market Committee. We have questions, all right? Journalists can come and ask questions, and this is the best moment, all right? This is the best moment. Why? Because they actually ask what we want, sort of thing, like what the market wants to hear, because they need to drag audience to their website, all right? So they need to ask what the market wants to listen to. And one of the guys asked him, do you see as the market it's seeing right now, Fed cutting rates in March? Do you think that the Fed will follow sort of the market expectations that there will be a cut in March? Somewhere between those lines. Jerome Powell very politely said, FOMC and the Fed takes a decision on a solely based meeting, and we didn't have discussed yet. So then what the Fed done is, okay, so we're having higher US CPI, we're having higher core retail sales. Ooh, that's good then. If they will maintain the interest rates higher for longer, they're not gonna cut in March. let's buy a bit more US dollar. That's exactly what I've done. So in a sense, it was bad sort of for the US in the first couple of days. But then after that, as we see, we had US lower unemployment, we had higher NFP, and we had higher US manufacturing. This was the combo. I mean, come on. 1, 2, 3. This was the triple Q right there. All right, especially this guy here, US lower unemployment. All right, more people getting employed, much higher NFP, much better manufacturing. It was just like very bad for the Europe, so very good for US. And this happened until here when we had a higher US inflation. Remember, when we look to June 2023, last year, the Fed actually said we will have a sticky inflation in 2024. Okay. So the risks are tilted always to the upside. When it comes to a sense like risks tilted, what I mean by that is, okay, we're gonna have, let's just say, just interpretation. So we're gonna have US CPI next whatever day, right? And the consensus is expected to be at 0.3%. All right. Expected to be 0.3%. The previous was 0.2. Okay. What I mean by risks tilted to the upside, I mean by I'm expecting what the consensus is expecting if this is higher than the previous, but I'm expecting more. Either way, I'm bullish. Does it make sense? I think it does, like pretty straightforward. Higher than the previous, expecting higher than the previous, but risks are tilted to the upside. That means that if it comes, it will come as consensus or higher. All right. So that's my view on the US inflation right now. And that's not what I'm saying. It's what the Fed have been saying as well. So it's just not me. Okay. Then we go to a new wave. So there's half of the month, pretty much actually, that was exactly half of the month. It's crazy. That's Friday. First, here. Okay. So that was actually half of the month. So 50 day was here, 15 was here, and we switch it gears. All right, half down, half up. So basically break even on the month. Anyways, after that, let me zoom in here. We had higher US inflation, but the market reacted negatively. Even though we had higher inflation, after that we had a speech by Paul, if I'm not wrong, and he said something, I can't remember what he said, and it was bad for the US dollar. And then we had still another bad US retail sales. And why we didn't have anything from the US, Europe was gaining stronger, lower US GDP, and then we had a higher inflation on Euro, lower manufacturing PMI, and lower services PMI for US, and still strong for Euro. ECB rate, hawkish Lagarde, high Euro, NFP unemployment lower, average hourly lower. So bad for US. What I'm looking now, 1.10. This is what I'm looking for Euro dollar right now. Is anyone looking sort of the same thing, or how is everyone thinking? No? Well, hopefully you guys looking for the same stuff. Okay. Now we have something very, very important today. There is the PPI for the US. PPI stands for Producer Price Index. So PPI stands for Producer Price Index. Okay, Producer Price Index. That means we're going to have the inflation coming up tonight, 11:30 from in Sydney time. So it's going to be 11:30 p.m. I don't know if I'm going to be in the office, but yeah, maybe. We're going to have Producer Price Index, 11:30 p.m. And this is going to show us if inflation is actually sticky on the consumer finer end, or if it's actually sticky as well for the producer price. Sorry, for the producer. Okay. So one of my mates actually, he said, with the market closely monitoring but not taking action after this week's US CPI, today's PPI data will be key to outline whether inflation is also resurging sticky at the producer level, not just the end consumer. Inflation is not black and white, up or down. It is measured across various sectors. So understanding where and how the inflation is prevalent can give deeper insights into inflation dynamics within an economy. To add these two, we also have more consumer data retail sales, which is forecasted to rise along with unemployment claims, which is expected to remain stable. So, you know, and we still have the retail sales, as he just mentioned. So my take here is, if inflation came higher for the consumer, let me take the, here, this one. This is the one I want. So United States PPI month over month and retail sales month over month. So the expectations for the PPI is at 0.3%. So remember, the risks are or as consensus or at higher than consensus, okay? Not lower than consensus. United States retail sales month over month, negative from negative 0.8% to 0.8%. So that means that we may have, again, higher retail sales, right? Because we had here, let me show you, where is my dollar? Oh, sorry, if we have higher retail sales, that's going to be bad because the average hourly low earnings came lower. So what does that show? People keep spending. They haven't stopped spending yet, right? So with high inflations, this is not good, all right? Because then your money is not worth, you're not leaving your money on the savings account as the bank wants, as the central bank wants you to. Therefore, this will be reacted as negatively for negative for the US dollar as well. Okay. Do you guys have any questions regarding that? Okay. All right. So I've talked about euro dollar. That's my main pair for this week. I've talked about gold as well on the beginning of the webinar. Let me just show you here. All right. When we had the CPI that was on this day here, Wednesday, look, we had this massive sort of 2 hours spike up on the US dollar index from here all the way there. But we just came back. So this is just show me that the market is not looking to the CPI at this moment. But we need to check how the market will react to the retail sales. They react positively. That means that, yes, now we need to pay attention on how the consumer spending are going to be. Okay. So this is basically how you do to interpret what the market is looking to or what the market is not looking to. But always keep an eye on the central bank. Always keep an eye on them. Always. All right. What else? I've talked about 10 years, 2,150 on gold levels should hold if PPI stays. 2,150. Look, man, you know, you can be right because that's a support on the all-time highs. So that may be a possibility. Yes, there may be a possibility. So we see how we go tonight. Okay, I've talked about my expectations. It may be a little bit as expected or a little bit higher. All right, guys, this is all from me today. Do you guys have any questions? I know we've focused on the euro dollar today, but I just want to, focus on that so we can get out from the way the fundamental back testing. And next week we will be coming back to normal, let's say, nothing fancy, going over the calendar, reaching out the numbers and seeing what we can have the opportunities. Any questions? Thank you, Whip. That was a very nice comment. I really appreciate your feedback, man. Thanks everyone to come today. And I see you all. Thanks, Matthew. And I see you all on next Tuesday. All right, guys. Thank you. Bye-bye.